Welcome back to the Ramp Up to Retirement podcast with your host, Dan Reese. Dan, good to see you again.
Yeah, great to see you, Bill.
This is going to be an interesting episode because looking ahead at the notes, you want to talk about estate planning. But one of the things that I think you want to make right up front is that estate planning is also actually really tax planning in disguise. And that intrigues me. So what do you mean by that?
Well, you know what's funny? It's like, you know how bad it is for people getting their estate planning done. Everybody's like, yeah, I really need to do that. So part of today's episode, I hope, is that it'll get people to think, oh, wait a minute, I might actually be able to save some long-term taxes if I do this right. And so, yeah, you can't separate them. Good estate planning really is connected to your tax plan, as we get into today. And it's like, you need to understand that how you structure all these things is going to have a pretty big impact on the long-term total taxes you pay. So when you think about this stuff, I think a lot of people just think about taxes they're paying during their retirement or during their working lives.
Right.
Well, the IRS has different plans. They love retirement accounts. They love a lot of these things. And it's like, okay, well, if you don't pay attention, we kind of hope that happens because you may be able to have reasonable taxes through retirement, maybe not, but your heirs may have massive taxes that you don't even know exist, right?
Yeah, totally. So I got a lot of questions here for you, Dan. But before we go any deeper, why don't you lay out for our listeners who may be your first-time listeners on the podcast, who it is you work with and who this is focused at?
Yeah, I mean, really what we always talk to is usually people 5 to 7 years from retirement. They're coming up on a lot of decisions they need to make. But a lot of the things we talk about here today specifically is going to really apply to many people. Now I will tell you, because of the compounding nature of money, the longer you take to address things, the bigger the problem can become. And we all have a limited number of years on earth. And so sometimes if you wait too long and you get into your later 60s, 70s, and you start trying to address some of these things, it's not that you can't make an impact, but it can be more difficult, right? Because you just don't have the number of years for these decisions to compound positively.
Totally understand it. So let's get into this. And I'm going to start with this whole thing that you just mentioned. People hear estate planning. I hear estate planning. I think wills, lawyers, and to be candid, it's something I keep putting off because I think I'll get there, at some point. But why is that model of thinking actually kind of dangerous, Dan?
Yeah, well, I'm going to back up just a minute because one of the things that I want everybody to think about is we call it the 3-lane highway, right? And so when you think about money, and I think this is an easy way to kind of conceptualize it because, human beings like things of threes. I think it's easier to remember things. I know there's research around that. Bill, I don't know if you've ever read it, but
a lot of it actually.
Yeah.
Yeah.
Certain things stick, but the three lanes of the highway we talk about are investment planning, which people are familiar with, buying investments. How do I build a portfolio? Making sure I get decent returns, all those kinds of things.
Sure.
But then you've got retirement and income planning as the second lane. So when you think about that, that's okay, how do we take all that stuff we've accumulated, all those resources, and create a retirement income plan that's going to work for us, provide what we need over the course of retirement. And then the third lane is really around tax and estate planning. And so that's what we're kind of focusing on today. But it's interesting as we talk through these things, because I just want listeners to keep those 3 lanes in mind, because you will notice we actually talk kind of about all of those as we're mentioning these things. Because, what happens is it's like a lot of things in life. If you pull a lever in one area, oftentimes it's going to affect other areas without you even realizing it, right? And so I just want to kind of touch on that as we start talking about it, because really, what do most people think about estate planning? Oh, I got to go get that stupid will done, or that
lawyer hasn't called me back yet. I need to go sit down and figure out a time to get with them. That's what I think.
Healthcare documents. I need all these documents, and I hate it because, number one, I don't really fully necessarily understand everything and what it does. Secondly, it's just I don't like thinking about that stuff.
Yes.
Because, end of life or being incapacitated or whatever it might be, right? So I just want to get really clear on this. Estate planning is not a legal document problem. Does that kind of make sense?
Yeah. Well, in the context of what you're talking about, yes, it makes a lot of sense.
Yeah. Yeah. They're tools, right? The documents are just the tool to implement your plan, right?
Mm-hmm.
And I think a lot of times people kind of take it the other way, like a checklist. I just got to go get these things done.
Yeah. No, and candidly, Dan, that's exactly how I think about it. I think of it as a checklist. Oh, this is the box I haven't checked yet. So, yes.
100%. So the strategy in estate planning is really the tax strategy, because you want to make sure, number one, things are going the way you want them to go with your estate plan, as far as who receives things, how they receive them, all the stuff people kind of think about. But also, what is your tax strategy to make sure that currently, you pay the least amount of tax over all of that whole cycle,
Yeah.
both your time on earth and then as assets pass on to the next generation.
Well, Dan, what you're actually talking about, or at least what I'm hearing, is that you are saying that estate planning actually starts affecting someone financially while they're living, not after they're gone. I mean, obviously there are implications for after they're gone, but it's a here and now issue too.
Yeah, I would say, number one, you're right. It's happening while you're living, because that's where you can take a good strategy, which we're going to kind of talk about, implement it so that you have what you need through life. But then wherever things go, when you're gone, do that in an efficient manner, because you can't do that at the end. And we're going to get into that. And just a couple other things too is, like, number one, this is just a little thing because people get really confused about misconceptions around estate planning. So I just want everyone to understand, one of the things that's really important is beneficiary designations are part of your estate plan, meaning that you could put one thing in your will, but the beneficiary designation is going to override that.
Oh,
I just want to mention that because a lot of people get confused around that. So that's a good little tidbit, right, around those things. So just keep that in mind as we talk through these things, because sometimes, like, that's why planning's so important. And just to mention where the mistakes are made, or the misconception is that if you have a true plan where you're like, here's what I would like to happen, before you start creating the tools, right, whether that's documents, beneficiaries, all those things, you're going to get where you want to go. If you just do things haphazardly, bad things tend to happen, right?
yeah.
I think that's really important. And then one other thing, business owners. I know there's business owners that listen to this.
Well, I hope so, because you did an excellent series for business owners that was outstanding. And if you're a new listener to the podcast, I would encourage you to go back to listen to that series after you're done listening to this one.
Yeah, because we talk a little bit about this stuff for business owners, but keep in mind, this is a whole different issue, because your estate plan, oftentimes, for most all business owners, it is a huge part of your estate.
Yeah.
And not having the proper planning in place can be it can put your business out of business, right? If you're gone without having the proper things in place. So, like, that's a huge thing. But understand that many attorneys can write that stuff up, but if you don't have that plan on what you truly want to happen, it's pretty much impossible for the best attorney in the world to write anything up. Does that kind of make sense?
No, it does. It makes sense. And I can see for business owners, well, I know from talking with you through the series, these issues are way more complex for people who own businesses, more complex than even they often realize themselves till they sit down with someone like a financial planner like yourself, who like lays it out and says, hey, these are the things that you need to be thinking about. These are the things you need to consider now. So yeah, it makes total sense. Now, Dan, you talked about those 3 lanes.
Yeah.
And we obviously are talking about the estate planning lane right now. To explain sort of the financial decisions that are really estate planning decisions, because you kind of shifting our perspective on this a little bit.
Yeah. And this is really important because this goes back, we talked like misconceptions a little bit, but here's the reality. Like, your estate planning, everything, all 3 lanes of the highway, your investments, your retirement plan, and your tax and estate plan, your estate plan kind of is involved with all those things, right?
Yes.
And so it's really important. So I'll talk a little bit about some simple examples of that, right? We've talked on prior episodes about Roth conversions, hot topic. People always want to know, hey, should I do a Roth conversion? Should I not do a Roth conversion? Matter of fact, just had a call this morning. That was specifically what they called in about. They were like, hey, I don't know, and what's interesting is that, so if you think about this, the new Secure Act, which was done a couple of years ago, substantially changed how beneficiaries receive money. And so one of the things that happens if you leave an IRA, a pre-tax IRA, to a child or to one of your kids, they have to have all that money out in 10 years, right? That is part of your estate plan, right? How that money passes to them. Well, let's say, for example, you started doing Roth conversions. Well, guess what? Roth conversions are going to basically move money from a pre-tax account to a Roth, and you're paying tax on that income as that happens. But now that it's in that Roth bucket, guess what happens? Now, when you pass away and it leaves it, part of your estate plan is that money goes to your kids. They get 10 years where they don't have to take it out, and it can continue to grow tax-free, as opposed to when it was in the pre-tax account, it's all growing taxable. So like many times kids are in a high income earning years when they inherit that money and they have to have it all out in 10 years. It could be a disaster. They could have to pay massive amounts of tax on it, right? So in this example, like that Roth conversion actually is part of your estate planning. And a lot of people don't even think of it that way. They're like, oh, I'm just doing that to save some taxes for me. And it's not really clear how that impact can happen, how it can impact their next generation.
Yeah.
That's a great example. Another one is like we think about investment planning. How do we position assets in our brokerage account, not our IRA, right? Because oftentimes we're going to leave that money. Again, it's going to go to our kids or who knows, there could be charities, other things involved. Well, guess what? One of the best things about brokerage accounts is when somebody passes away, those assets get a step up in value, which means all those accumulated gains that have happened through the years, now the kids get at the current value. Well, I think that's pretty important when you're thinking about your estate plan. But guess what? That's actually part of your kind of investment plan, how those things are positioned and, how you realize gains and all those other things. But you kind of getting the point, like we're making decisions in these other areas, but it all comes back to how it affects our estate plan and the taxes in our estate plan. A couple other things like annual gifting and using like 529 plan super funding where we can get money out of our estates. Well, part of our estate plan was to help fund our grandkids' education. We can do these other things in these other planning areas that actually completely changed the taxes on our estate plan and how much we pay and how much our kids pay. Just simple examples of how decisions in these other areas, how it's all combined. Like all the 3 lanes of the highway, when they're looked at comprehensively, help you have a better estate plan, that's reducing taxes and still accomplishing everything you want. So those are kind of some examples of that.
That is fantastic and really enlightening, as a matter of fact. So, Dan, what are some of the most common costly mistakes that you see families make when they haven't had tax-focused estate planning?
Yeah, I mean, there are a lot of mistakes. And so I'll give you a simple one. You've got a client that has these different buckets of money. They've got pre-tax accounts like IRAs, which most people have. They have some brokerage assets, some real estate, some Roth money. And they had some goals that they wanted to, there's a certain amount that they wanted going to these charitable causes, and the other was going to go to their kids. Pretty straightforward. That's actually very common. You know what I mean? You have like, hey, we do want to include some charitable causes in our estate plan. So what they did is they just went to the attorney and they said, hey, we'll just put all of our assets in the trust when we die, and we'll just split them up that way, right? Seems reasonable at a top level. Well, here's the thing that they didn't recognize, which actually cost everybody at the end of the day. You can pass pre-tax IRA assets to charity with no tax because they don't pay tax, right? And so like if you were going to split up that money, like you would want to make sure, hey, if for the percentage we want going to charity, let's make sure that comes out of our pre-tax account. And so that, we're not giving charities Roth money and after-tax money and real estate that all gets kind of a step up, like basically has better tax consequences for the heirs, right?
I got a quick question on that because you've talked about qualified charitable deductions in the past. Do you need to does that need to be part of the estate planning as opposed to saying, well, I'm going to give X amount of dollars to, charity A? Does it need to be structured in a way that it just goes from your account right to them? And does that
Yeah, and
apply there?
that's a great point. Yeah, QCDs, we're talking about estate and tax planning. Yeah, qualified charitable distributions allow you to give that money pretty much tax free, out of your IRA, and it can help fulfill part of your required distributions. That's definitely part of that asset transfer plan, right? And it really is important because that goes into play with how all these things interact. And that's really the message we're trying to get across is that everything you do is going to have an impact on these different areas, the different lanes of the highway, right? And so that's a really good point on that. And so one of the things we got to be careful about, kind of that example is treating all of our accounts the same, you know, because one of the other things about that is that there's something called asset location. So this is our investment lane, right?
Okay.
But it overlaps with our tax lane and our estate lane. And what that is that if you say, let's say most people that get in retirement, they're not aggressive anymore with their investments. Most of them typically are more moderate, right? Because they realize, hey, we don't want to deal with all the fluctuation. We want to make sure we've got money available for distributions for our income, hence the retirement planning lane, right? All these things continue to overlap. But what they sometimes miss is that you should hold different investments in different accounts. Because if you have that pre-tax account that every time it grows, the IRS gets a little bit more money because their tax chunk of that, we should really be holding more of our safer or fixed income investments in that account that don't grow as much, right? And then we would want to hold more growth assets in our Roth accounts and our after-tax accounts because we get the tax-free nature of the Roth and we get the step up in value on the brokerage account. So we don't want to treat all those accounts the same, when it comes to investments. So not only does it matter who's the beneficiary, if you're including charities, we don't want to treat them the same, but we also don't want to treat them the same with what's in each account because that is going to affect your estate plan and how much taxes are paid in it over your time and your heirs' time. So, a couple really good examples of, you just have to be careful. The real world impact is significant. And we've seen, you want to talk about dollars and cents. It can be hundreds of thousands of dollars. Honestly.
Yeah.
When you start factoring all these things in, and all of a sudden you really didn't, Brent and I in the office always talk about that. You didn't really have to change anything on your living standard or spending less money or anything like that. It was a matter of like being aware of how to take advantage of some of these tactics to fulfill your estate plan. Does that kind of make sense? We're kind of drawing it back into like, what do we really want our estate plan to do?
No. It makes a ton of sense. And also, you got me sitting here and I'm listening to you and I'm thinking about this and I'm thinking, this is the value of talking to a financial advisor. And I can see where somebody who's doing it themselves, the DIYs, again, that's probably me. There are things they have overlooked, mistakes that they have made that could have been avoided. And I'm sure you've seen that a lot.
Yeah, the benefits are immense because I talk to people all the time and people tend to focus on investments. That's the nature of that's what we're drawn to, right?
Oh, yeah.
Which is fine. That's an important part. That's one of the lanes of the highway. We want to make sure that's right. But when you start understanding, when you put it all together, when you start looking at what it looks like, when you actually are looking at all three lanes of the highway comprehensively with your planning, all of a sudden, all these little benefits start popping up. You know what I mean? It's like, hey, we just reduced our taxes while we're living to some degree, because we were smarter about how we manage that. Hey, we were going to have this thing called IRMA on our Medicare extra premium because we didn't know if our income got too high when we were on Medicare, we would, those premiums would go up.
Yeah.
And because we addressed that earlier, we don't have that now, right? Or maybe we just have it for a year or two because we made some strong moves to reduce it long term, right? All of a sudden, your income is much more consistent. Like what's happening. It's all laid out. your social security strategy, all the stuff that you have to make decisions on. And it all flows right into your estate plan. And so that comprehensiveness, you're giving yourself a lot more, I don't would say confidence that, hey, all this stuff is systematically being addressed versus just staying in one lane of the highway where investments, 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 and you're kind of throwing away all this money on the back end because you just aren't aware of how these other things affect your long-term plan.
Yeah. You know what? I want to go back to something you mentioned earlier, Dan, because I was surprised. You were talking about beneficiaries and
Yeah.
talking about being careful because what's in your will may not necessarily reflect what's on your accounts. And I wasn't aware that the accounts would have supremacy in terms of that. Just talk a little bit about that before we head on to some other issues, would you?
Yes. I mean, and I think, and I actually meant to talk about, I'm so glad you brought that up because one of the things that's really important is beneficiary audits. So beneficiaries are a legal contract. So life insurance beneficiary, retirement account beneficiaries, you can put beneficiaries on a lot of things. Some states are even allowing, beginning to do some with homes and to simplify, estate processing. But that's a contract. And so a beneficiary audit, what that is to look at all the accounts you have, verify who the beneficiary is, how that's structured, who the contingent or secondary beneficiaries are, in case the first person, is not living any longer or doesn't accept it.
Right.
And so those are kind of top dog, right? So, people talk about trust, wills, all these things. A will is really the instructions for the probate court. That's really helping them. At least, I'm not an attorney. I want to make sure everybody knows that.
Understood.
But attorneys have told me this, that basically, these are instructions for the probate court. And so that's why trusts are so powerful because, trusts avoid probate because it's a legal entity. The trust owns things. So basically it hasn't gone, there's rules in there where everything's supposed to go and all that stuff. And the only way that would end up in court typically is if there was somebody raising a lawsuit. Well, I don't agree with it.
Yeah. Okay.
You know what I mean? Where if they process just a will, the probate court's going to go in and they're going to interpret it and try to make sure things happen like they should. But legal contracts are generally going to, be ahead of that. They're going to happen first. So very important. Yeah, the old divorce situation, which is the most common one.
Oh yeah,
the old
you're
life
say,
policy.
Yeah.
It's like, oh my gosh, my ex-wife's on there, my ex-husband's on there, and that's why that beneficiary audits can be really powerful. So,
very true. So, look, if a listener today is 5 to 7 years from retirement and has not had a real tax-focused estate planning conversation, what is the one thing that you want them to take away from this podcast today?
The big thing is that, my belief is that most people, if they're educated on these things, can start to take action to correct them, right? So one of the things that we've done, and I think it's the best way to do this, is that we've kind of we've put together 30-minute strategy sessions. And the whole point of this is that, look, this is kind of a gift. This is not a sales pitch. There's no, hey, you got to come work with us. All this is that we've set aside time on our calendar, and there'll be a link that we can send you. You can either go to our website and get the link, or you can, I think we might be able to put it in the show notes too. But the point is that you and I, or you and the listener, get on a Zoom for 30 minutes and just talk through kind of the basics of what is important to them from an estate planning issue, right?
Mm-hmm.
And then we can talk through kind of how are things positioned today? And are there things that they may want to consider that they can take back to, if they have an advisor, they could take it back to their other professionals, whatever it is, or they could have further conversations with us. But the point is that so you can begin to understand what are things that could be affecting your own situation, because, that's all you need to do. Be aware.
Yeah. I was just going to say, if you're listening to this and you realize just from this simple conversation, there might be a gap in here somewhere.
Mm-hmm.
Reach out to Dan. I'm going to ask Dan how you can do that in just a second, but reach out to Dan because I want to underscore something here that Dan alluded to. This is a free conversation. It's a no obligation conversation. You could talk to Dan and think, oh, now I know I'm going to go back to my financial advisor now with better questions. But reach out. It doesn't cost you anything in terms of money or commitment or anything else. And Dan, with that underscored, what is the best way for them to reach out to you?
Yeah, our website's the best way, honestly. It's got all our phone numbers. There's a contact us page on there. You literally, you could go in there and write, hey, send me that strategy meeting link. It's fine, right? We'll email it back to you so you can like pick a time that works. But I do want to stress what you said. I know I'm kind of nerdy, but I love this stuff and I love talking to people about this stuff.
Well, that's kind of on your financial advisor.
Yeah.
Okay,
And I really like the opportunity to help people, like at least become aware. I have conversations all the time where people are like, I had no idea, about any of that stuff that little old me could make all these improvements. And we get people say that because people always think, well, I have a simple situation. And I always say, like my accountant friend says, there's not really very many simple situations. Most people it's a little more complex than that. But, the truth of the matter is like having a conversation online is, number one, it's easy. Like, we don't bite anyway, but it's like nice and simple. You can get that input and that way you can feel more secure about the decisions you're making. That's really all it's about.
Absolutely. The other thing you can do, folks, that costs you nothing is if you're not a subscriber to this podcast, just hit the follow button. Beauty of that is when you hit the follow button, you're alerted every time drops a new episode of his podcast. You can give that one a listen. And I'm going to add a request in here. If you like this podcast, give it a like. Tell people about it. Let them know. Word of mouth from a person is the best thing that could possibly happen, as opposed to a bot telling you, hey, I think you'd be really interested in. So do that. Okay. Do that. Right. Until next time. Oh, by the way, and speaking of next time here, before I wrap out, Dan, what are we going to talk about in the next episode to give people an incentive to hit that follow button?
Yeah, we're going to get into in our next episode something that I think is really interesting because people ask me this stuff. Hey, I think my advisor's doing a good job, but I'm not really sure. And we're going to give you tips on how to kind of measure that and really kind of have a better feeling of whether you need to learn some new things or whether you're in great shape. Because, the goal is like, I always tell everybody, we can't handle everybody that needs help out there. We want to make sure the idea is that people are getting good help.
Absolutely.
That's my number one goal, that people are getting good help. And so we're going to talk about that next time.
Excellent. So until next time, I'm Bill Tucker. On behalf of Dan and everybody at Avery Wealth, thank you for taking the time to listen today. And we'll catch you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.